We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Financial Partners. This is the Finances podcast market update. I normally number these podcasts, Ben, but we get in a bit of trouble when we want to get them out quickly. So this is the 13th of September, 24. Today's guest is Sam Crompton, Senior Investment Advisor at Shaw and Partners. We've had Sam's partner in crime, Adam Dawes, on a couple of episodes. So Sam, it's good to have you on board for your first episode with us, mate.
Yeah, it's nice to be here. Thanks for having me. Always keen to chat about what we do and how we work with you.
Beautiful. And I've got obviously my partner in crime, Ben Kemp. Ben, how are you, mate?
Good, Jay. Thanks for having me on again.
So today, I thought what we do, similar to our previous market updates, is just give a bit of an overview of sort of the globe more broadly, what's happening that's impacting us. I know, Sam, you did a client update a couple of days ago, maybe it was a week ago, sort of talking about the Aussie market being beyond 8,000. That lasted about a week. I think you need to change the name of your presentation because the market sort of dropped back under again. But let's start with sort of the global market, where you see things, talk then domestically, and we might finish off with a couple of stock stories. I know you spend most of your time probably in the numbers, in the weeds, and that's the exciting stuff that we want to have a chat about. But let's start more broadly.
Yeah, great. I think the primary issue that we're all grappling with is the interest rate cycle. So obviously coming out of COVID, there was a lot of money printing to stimulate and keep economies going, and everything that created inflation. And that's what being sort of the primary focus. Businesses seem to be doing okay, certainly in the US. But the interest rate cycle is the key. It sets the tone for a lot of things, obviously valuations, but also currencies. So we've got the US, it looks like they're slowing slightly, and it looks like the Fed has signaled that they want to start cutting rates soon. And I know overnight ECB cut rates, right? So potentially with the end of a rate rise cycle, and that's usually good for equities, at least in the short term. It also means that you've got a rotation out of financials into resources as the US dollar comes down. And we've been sort of reflecting that through our portfolios, hedging some of our international exposure, because as the US dollar falls, obviously Aussie dollar will tend to rise. So that's important. And I guess the thing that's got everybody glued to the screens is the US election, which is huge, right? And interesting debate the other day. But I think so Trump previously was positive for equity markets. The Democrats obviously seem to like spending money. It's all a little bit interesting, but I think you can expect if the Republicans the Republicans come back in, you're going to see, I think, a more broader approach to energy policy. So more oil and gas exploration. Trump's talked about opening up some of the deposits the US has. And so that'll be good for energy prices and a real welcome to businesses around the world. That seems to be a theme that got everyone talking during all the reporting season. Energy costs is a big factor. And I think that's important, right? Getting energy costs down. But yeah, it's interesting to see. Obviously, Japan had a wobble. ECB's cutting today. And obviously there's ongoing conflicts, which, it'd be nice to see those end, right? They seem to be going on and a bit too long for my liking, and it's costing a lot of money and creating supply chain issues, and it'd be nice to stop all that and move forward. But obviously when rate cycles stop, that's like sometimes you can be, what we're on the lookout for is like, do we get a soft landing or do we get a hard landing or do we get no landing at all? That's the biggest question, right? Because the whole concept of a rate rising cycle is to beat inflation out of the system and to slow it down. And so prices come down, the investment decisions get put off. So yeah, but primarily everything's ticking along quite nicely. We saw that bounce off the Japan issue recently. China's got some real issues with building sector, but underestimating China's been a mistake over the last few years. And they certainly seem to be focused on transitioning to a more technology-focused, higher-end focused economy, which is, I suppose, bad for resources, but good for technology. So we'll have to wait and see. But
what's your view on the landing, Sam? We always like to put you on the spot. I know when I spoke with Adam last time, I had a sense that he was probably not as bullish around the future, and this was probably about 6 months apart. Obviously, a lot of uncertainty in the market, but we won't hold you to this, but what's your view on the landing? Where do we sit sort of post beyond the US election?
Well, we always get recessions. We're always at some point in the cycle, right? So if you were to look at it now, you'd have to say we're closer to the end of the cycle than we are the start of the cycle, right? That's just the nature of interest rate cycles, right? You cut the rates to stimulate activity when it's low. You increase it when it's too hot. and you keep increasing it, or the Fed increases it until things start to break and things start to slow down, right? So we're certainly, given the fact that equity markets are all-time highs, are we closer to the end or not? I'm not sure. The tricky thing to know these days, though, is that reserve banks around the world are much better at responding to issues than they've ever been before, right? And creating money out of thin air that's how, like, there's a great book, The Deficit Myth, by a lady called Stephanie Kelton, I think, and she just talks about how money's created, right? And essentially, central banks around the world don't have a big pile of money stashed in a safe. They simply print it, right, and create money. So they can do that and stimulate when needed. But I guess I'm a little bit more selective in our investments now. Like, certain themes are going to keep going. Defensive themes, I think, certainly warranted. I think interest rates, if you're like, we're starting to look at, so some clients who like bond-like investments, we're looking at the fixed rate bonds, which I think look attractive. And in the portfolios, we'll probably be long things that benefit when interest rates fall, which is some utilities, because as interest rates fall, obviously their debt load decreases. But it's a little bit, I would say, up until the election, I would be surprised if we get some horrendous market crashes, because the Democrats want to certainly keep everything ticking along. They don't want to oversee a humongous fall in the stock market, because then Trump can blame them. So I would say we're strong, certainly into the election, and after that, we'll have to wait and see. But interest rate cycles, historically, like, cutting is a good thing. Too much cutting means there's too much pain. So we'll just have to wait and see. So I'm conscious that market fully priced in some areas, and you've got to pick the eyes out of it to buy the things that are cheap. But I would say, ask me after the election, because I reckon we're going to be strong into that.
So do you think in the lead up, we're in a bit of a holding pattern until that point, would you say? Or is it there's still likely to be some volatility? Or we just sort of, everyone's almost just waiting till, what are we, only a couple of months away roughly from it now? Is it just a bit of a hold until the election?
Probably. Like, I mean, your guess is as good as mine. I mean, nobody has a crystal ball. I mean, we can look at valuations. We look at historical valuations. We can look at what happens when rates start to cut. And generally, they seem to be quite positive for equity markets, as you could probably imagine. You know, what's going on in the world at the moment? Well, obviously, is that Ukraine thing and the Middle East, which is adding uncertainty. You've got China, which is slowing down massively. If they were to stimulate, that's great for everybody. Obviously, we've got an election next year in Australia, and, you know, everyone's surprised about the resilience in the economy. Seems like everywhere you go, like getting your car fixed or something, they seem to be continually busy, like hard to get into a dentist. Every sort of interaction I have with a retailer seems like they're pretty busy, right? And it seems like people are still spending money. Property prices are flying in Australia still. That's a big part of immigration. There's this massive, seems like everyone's upset about immigration around the world. Like, it's certainly an issue for debate in the US. It's certainly causing some unrest in the UK at the moment. I know it's a big problem in the EU. So that's sort of fueling population growth and adding to growth around. And governments are still spending a lot of money, which is really confusing, like, especially the Australian government, right? Like, they're spending a lot of money but fighting inflation at the same time. It's like, your role as government is to back off when inflation's running hot and save your bullets when things are a bit dicey, right? So, yeah, it's interesting. But we're coming out of something which we never ever seen before, right? So that whole COVID period was such a phenomenal amount of money printing. Like, I think that seems to be missed out on all the argument, all the discussion around the economy, right? So you shut everybody down for 3 years. You print, like, US dollars, 40% more US dollars in circulation now than there was pre-COVID, right? That is astounding number. Like, and then everyone can't go to work, and then naturally supply chains are going to be disrupted and met with lots of free money. Like, it's all coming out of the system now. But yeah, so it's quite interesting. But then overlaying that, you've got some really strong themes which will keep going for years to come, the net zero transition, etc. So yeah, it's certainly an interesting time. It feels like we're bumbling along at the moment. And like I said, we'll see how fast these rates come. If the rate cuts are fast, you'd be thinking that they know something we don't. If they're gradual and spread out, then maybe they've engineered a smoother landing.
Just on that rate reduction, obviously with the US kind of taking the lead, and domestically, it's probably a nice segue into sort of the domestic situation. What are your thoughts on how much of a lag behind the US we would have in terms of rate reduction, and the impact that maybe has on some of your decisions around some of the domestic opportunities that exist?
Well, I think Australia seems to be strong, and it kind of makes sense it is, because we've got, well, first of all, immigration's going through the roof, right? And that's keeping spending happening. So supposedly, we've got a big mining sector and very busy, right? So That's helping out employment. Maybe it'll come off a little with the lithium slowdown in WA with a few projects being put on hold. But I reckon that Australia will be delayed slightly for the rate cut because we're stronger than the US. I think we're still firing along. There's no massive signs of slowdown. Sometimes they can come quickly, but I reckon US cuts so its ECB's already gone today, and how far US is signalling they're going. I think we might not be straight. It might be straight away. I mean, I think Chalmers is angling for. I don't know. He seems to be meddling with the RBA for some reason, but yeah, we'll see. We're still strong as an ox here in Australia, right? So it doesn't mean that can't change quickly. And sometimes when you're at the top, the only way to go is down. But we're pretty robust, and we're set up. Like if we are doing this net zero transition globally, and I say that because there are cracks appearing in it, right? It's pretty hard to force people to change the way what they drive, and there's a lot of money that needs to be spent. But we're in a marvellous place, right? We've got everything that the rest of the world needs in abundance. Fresh air, a lot of space, natural resources. Like we should be pushing the pedal. If we had great leadership, and it's not partisan here, it's just why can't we add more to our commodities? Why can't we add the second stage of production or the third stage, create jobs? Why don't we have cheap energy down here when we're abundant in it? Why are we sending it off seas to give everyone else the advantage, right? So I just think we're in an amazing position. And I think we're pretty strong at the moment, but that could change. But rate rises will be greeted with open arms by those with a mortgage and the pensioners with lots of money in the bank, and they'll probably be less excited. But I just don't see the only client. So I always like to talk to my clients about what's going on in the economy. We have lots of different accounts. The farmers are a bit unhappy about sheep export ban, but the one sort of canary in the coal mine is a client who's a car dealer in Sydney, and he's saying that COVID tax has gone from new and used cars, and there's lots of cars that just aren't selling. But he said that a year ago, right? So everyone else seems to be steaming along.
Is there a risk there, and I suppose in the fact that there is still so much strength in the economy that rates coming down quickly, we run the risk of spiking that inflation again? Is that why it would likely be gradual and why they're going to hold for a period of time?
Well, that's what I think, yeah. Because absolutely, yeah, because we're strong, right? We're stronger, right? That's primarily why. Also, I guess one benefit, though, is if the Aussie dollar gets stronger against the US, then imported goods into Australia are going to get cheaper. So that'll help with inflation, right? So, and if the government reduced their spending, you would get less pressure on spending as well. But yeah, primarily because Australia is stronger and showing less signs of weakness than the US.
So kind of given the sort of fully valued state of the market at the moment, robust conditions here in Australia, solid. How does that sort of pass into how you're thinking about the construction of client portfolios? Obviously, it is sometimes people think very binary around the market. It's either doing well and they're crushing it or they're losing funds, when the reality is for us, and one of the benefits, we said this on our last chat with Adam, the value for us in having the likes of yourself and Adam looking and making decisions is that you are at the coalface. You're actually looking under the hood at what's going on in the market, and also looking under the hood at what's happening with particular sectors and individual stock. How are you thinking about it at the moment? And maybe that's a reasonable segue into some specific stock stories, what you're liking, what you're not liking, and maybe where some of the opportunities are.
Yeah, great. So I guess the easiest one we've been doing, as you guys would have seen, is adding some hedging into our international exposure. So we've really enjoyed returns with QUAL, which is an ETF which selects the best companies, low debt, high return on equity. It's got a great performance, just shy of 17% per annum over 5 years, right? And so those equities that ETF owns predominantly in US dollars. So we started hedging that about 6 months ago because you could see that like the rate cycle was coming to an end, and we started hedging, like buying the hedge version of that essentially, right? And predicting currency movements, like it's notoriously hard, but you can just sort of broadly see where we're at with the cycle. And as rates start to fall in the US, we expected them to fall less so in Australia. So that was an easy call. When you start getting rate cuts, then obviously things with higher levels of debt tend to do better, because obviously your debt burden is decreased. That means Australian Pipeline Trust has been hammered. That's been a good one. We expect that to come back, primarily because they're essential also in transporting gas around Australia. We're going to be increasingly reliant on gas. Gas is, they call it a transition energy, but it's here to stay. So that's been good. And so also probably the bigger move is commodities, financials out of commodities. When the US dollar weakens, it's great for commodities because they're priced in in US dollars. And so that generally signals the start of a commodity cycle. And also the thing why we like commodities a lot, and when I say commodities, we mean BHP primarily is the catch-all for that. And I'll drill into the other commodities afterwards. But essentially, like you've had so much money printing and so much creation of currency, you can't magic that up with commodities. Clearly, you can't print, iron ore or can't print copper. So their value naturally goes up in a dollar sense, right? So we've always been holding BHP for that reason. At the moment, it's copying it because of iron ore, because of China. But 45% of BHP's earnings is copper, which if we want energy transition, we need that. So that's a perfect one. It's down. It provides a better yield than CBA. So we're doing that rotation as well. So, yeah. And also just generally, we look at stocks on a 10-year view. And if you look at all the four major banks, the only one that's made you a lot of money or doubled your money is, well, actually, I'll include Macquarie in there. So let's say 5. 10-year chart, basically Westpac, National Australia Bank and ANZ have done very little over 10 years, which I think is pretty average, right? And the reason being there's 26 million people in Australia. There's only so much debt we can take on. There's only so much income we earn. Everyone's full. So where do you get the margin from? Well, at the moment, they've got the margin from higher interest rates because they can charge more. And that's going to reverse when rates start cutting. And so commodities are a better bet, in my opinion. We obviously like Macquarie Bank. That's got a global market focus and they make money rain, hail or shine. Obviously less in a downturn, but that's been our primary focus. But apart from that, it's probably more stock specific. So hedging. So in summary, with the expectation of where we're headed, we're adding, I guess, more utilities and securities that have gone down with debt, like Amcor, APA, and we're hedging stocks that are exposed to a falling US dollar, that being QUAL, QUAL, and going to QHAL. We are keeping, I suppose, one foot in each camp with Hyperion that doesn't have a hedged version. So we've got some hedging, not all, because you never know what's going to happen. That's probably the main focus. Yeah.
Just a comment on the BHP, because again, I think nearly every second Australian probably has some exposure to it, a bit like CBA. But is there just a comment on at the moment, and I suppose the potential for it to maybe take a while to get momentum because of the China situation? Is there a chance that this is, again, we're not expecting that it's going to rates drop a bit and it start to take off sort of thing? Would that be correct?
I think a weak US dollar will help BHP. So let's just call BHP iron and copper, essentially, right? Iron ore, there's like Vale is, so I'd wind your clocks back for a few years, and Vale had this hideous spill and over there, and the massive curtailing of production, and that led to a big spike. They look like their production's coming back on. Resources has got some coming on. Rio's got some iron ore coming on. So it looks like the market's going to be fairly well covered for iron ore. What's good, though, is the need for steel is broadening. It used to be China's 70% of global demand, which is a crazy number, and that's going to pull back, but the rest of the world need to spend as well. So I think a lot of the negativity in iron ore is factored into BHP. And where else do you get like such a large company with 45% exposure to copper, some of the best copper in the world? And copper's really hard to find, right? Really hard to find, takes ages to develop mines. And so I would say BHP is looking close to being attractive. And we, in hindsight, if it always seems to hit $50 and then come down again, and then it's a buy in the high, like it's like clockwork. And it's not one we time a lot. We just we like commodities, and we've been certainly bullish on commodities ever since coming out of COVID for that whole money printing concept. At some point, we think they're really going to do a lot better than they have.
Maybe with the copper theme, just briefly, I know we didn't talk about this. We weren't going to talk about this, but maybe on Sandfire, which we have had for a period of time, which has done pretty well. Like, is that, again, we're already in there, it's already done well. Is that a theme of continuation? Like, you think that will continue on to, again, it's done well, but still plenty of upside?
So I think, copper's going higher regardless, right? So to get net zero, we need 4 times the amount of copper production currently than to meet all the demand, which is a nutso concept, thinking if you think that the world's taken this long to get the current levels of copper production, how are we going to 4x it, right? It's not like I had lunch with a CEO in a company that we own yesterday. He just happens to be a guy who lives in Adelaide, and he's developing an asset in Canada called NextGen, right? And he was telling me about the amount of hurdles I had to jump through to get this project approved. And he's surprised about the amount of given the amount of capex that needs to come through and needs to be invested, you would expect you have your best guys on the government level approving projects and reading all the information to make it super fast, right? Because you can't shove net zero down people's throats and then not recognise that it's going to create the world's biggest mining boom that we've ever seen. Like, it's kind of ironic if you think about it. But to have that strong commodity prices, investment markets need to see where demand's coming from and then invest accordingly. So we had a big boom in lithium. Obviously, we're getting more money coming into the uranium sector. Iron ore speaks for itself. But you need this smooth operation of government that basically approves mines quickly and sensibly. And so capital's attracted to a country and we meet this production. It just doesn't seem to be happening with around the world, right? Like, it seems to be slow rather than fast. I can't remember the new last copper mine that's been commissioned. So, like, that's a real disconnect between pushing net zero and encouraging us to move towards that. And
what do you think that disconnect is, Sam?
Well, it's the lack of awareness about getting, like, to be pro-mining, right? If you're
but lack of awareness at what level? At government level?
Government level.
Which is insane, really, isn't it? When you think about, like, that should be the source of the certainty at government level to push and drive.
Yeah, because, I mean, if I was running the show, you'd sit everybody down, get a whiteboard and say, righto, that's net zero. That's where you need to get to, and then work backwards, right? So that means, what does our energy look like? Our energy mix, is it X% nuclear? Is it X% gas? Whatever it is. But whatever, let's just say currently the Albanese government likes wind and solar. Righto, well, what do we need to do that, right? Work your way back. And so you would come to a point in the chart where it says, holy smoke, you need to do a lot of mining, right? And so, because like I said, 4x copper demand, that's insane. Like, it's taken us this long to get there. So no doubt back to the Sandfire question, that's going to go higher, but is it fully priced on the current spot price of copper? Probably. But yeah, so there needs to be a warm embrace between everyone involved in getting to this net zero, and governments really need to approve and be pro-mining, right? And it's this weird world where mining is seen to be terrible and a bad thing, but you can't get an electric car without mining, right? And so it's like, well, where's the encouragement? Where is the lack of red tape? Why isn't everyone approving stuff left, right and centre? Because we should be in a hurry. If we're in a climate emergency, what's the way, right? But if you look at the headlines, what seems to be consuming whatever Albanese talks about, it doesn't seem to be pro-mining very often. In fact, he's standing in the way of Jabiluka and the stuff going on in New South Wales. So it just doesn't seem like we're pro-mining when need to be if you want to get to net zero.
Would that mean, from an investment selection point of view, and I think you might have mentioned this previously, like, you don't just buy obviously everything in the lithium sector or everything in the uranium sector, but looking at those, like Sandfire and those guys who have good existing facilities and they're already well underway, is that where you would preference in sort of the best of field sort of approach?
With copper, for sure, right? Because copper exploration companies is like, you've got to really want to do it, right? So for broader clients, you want to own a well-established producer who just gets exposure to the price that we like. They've got operation, if they like Oz Minerals, we own Sandfire because we owned Oz Minerals before, and Oz Minerals got taken out by BHP, right? So the next one down was Sandfire, and that's what we went with, right? So we don't want to take exploration risks for clients, because poking holes in the middle of the desert, that's what geologists do. And frequently, like, I think it's 1 out of 10 projects probably gets up, right? It's a hideous win-loss rate, but there's no shortage of little mining companies running around trying to part you with your money and invest in them, and they've got to try, right? But that's not us. We like two ways of copper, Sandfire, obviously BHP, and Wire is an ETF which owns all the copper market, all the world's biggest copper producers.
How does that flow through? I suppose maybe into a little bit, maybe we'll talk about lithium, which we're going to talk about in probably Min Resources. But again, that market, again, it's probably something that's probably required, but it's having a bit of a lull at the moment because of the big price of lithium. And just some context around that.
Yeah, so lithium obviously needed for batteries, right? And it's not a new industry, but it's grappling with the crazy high prices we saw the last 3 years, brought a lot of new production on. And it turns out that it's really quite easy to find, or relatively easy to find, big deposits that can satiate demand quite easily, right? And that's what we've seen recently. So that resulted in the price going down, and also EV sales have stalled a little bit, right? So there was an article in the Australian the other day, a lady, she said, I'm getting rid of my Tesla, and talked about range anxiety and problems charging. And I spoke to a client the other day who was in the UK, and everyone embraced EVs for a while. And then you've got practical problems, like when you turn up to a charging station, if someone's in front of you, you've got to wait for them, and there's issues. So we've got teething problems there. And obviously the price came off. some people speculate, when I say some people, I mean directors of Australian lithium companies, that China is keeping prices down because they'll just tell people to keep producing and they don't care. They're trying to maintain a strategic position because they dominate everything batteries, right? So they spent money when everyone else was dilly-dallying, and well done to them. But some speculate they're keeping the price down artificially. Who knows? But what we're going through at the moment with lithium, despite its very strong long-term outlook, is an oversupply. You're seeing, so a third of the global producers are losing money at these prices. So the way we look at it is you want to own unleveraged, low-cost, best-in-class assets, and that's Pilbara and Mineral Resources, but Mineral Resources got some other issues at the moment. And what that is that's the start of the cycle of getting through to the other side where you cut low-cost production, you hold off building new mines, and then hope demand recovers, and then obviously demand recovers and off we go again, right? And the thing to remember with everybody with lithium investing is that it's very cyclical, and it can be, and takes them off the top when it's flying, I suppose, is the important piece. And to be honest, it's been a 2-year sort of troughing period. And interestingly, yesterday or the day before, China announced that they're going to cut production from underperforming mine, and just so happened, like magic, on the same day, Mineral Resources managed to sell down $1 billion worth of one of their assets. So that was a double whammy, and hence the nice recovery in Min Resources. So if I could just touch on my strategy with Min Resources, so Min Resources got hammered after the results, and what the market got concerned about was high levels of debt and the fact they're spending money on constructing iron ore projects at a time when iron ore price is falling a lot. And so they have still capex to go, lithium prices falling. And the way I looked at it was, okay, I can't just keep holding Mineral Resources until it keeps falling and falling. It looks like 2 years is the time that this market's going to return to a stronger footing. So keep one, and if clients have got one, hold the other. Now, the natural inclination with clients is not to take a loss, and I get that. But at the same time, uranium is a commodity which solves all the world's net zero problems if everyone's to embrace it, basically. And there's a nuclear renaissance going on globally. The other day, believe it or not, 40% of global supply comes from a little country called Kazakhstan, which is not next to Russia. And they had a 17% downgrade about 2 weeks ago. And already the market was undersupplied going forward. And then Vladimir Putin the other day said, we're going to consider bans on exports on uranium, titanium and nickel, right? And some poor ex-CEO from Kazatomprom got arrested the other day in Russia. And it just looks like Vladimir wants to put his foot on Kazatomprom, and that's 40% of global supply. So imagine if Saudi Arabia disappeared from the oil market, like oil would go nuts. And that's why I'm a huge fan of uranium. But curiously, the prices of the equities have been hammered when you look at, so if you look at the price of lithium and the price of lithium stocks, they're correlated. The price of uranium and the long-term price contracts has gone up, right? Maybe the lithium spot price has come down a little bit, but the correlation between the stock and the commodity price don't make any sense. Add to that the global focus on net zero. There is a global renaissance going on. China's announced another 11 reactors. India's going to be building a ton of reactors. They're net zero. America's spending billions on reinvigorating their nuclear power. France is already 70% nuclear energy. Sweden's reversing their anti-nuclear policy. And what's clear is that, unfortunately, the solar and the wind isn't working for a lot of countries in Europe, and nuclear energy is a real focus. There's a great movie, if anyone wants to watch it, called Nuclear Now. Oliver Stone did the movie, which is quite amazing. I'm sure everyone knows Oliver Stone, but it just highlights like where policy got hijacked somewhere and they demonised an energy source, which quite frankly is a solid answer to what the world's trying to get to, right? So like switching out of Min Resources after obviously it's come down, but buying a stock that's gone down 50% that's got an amazing recovery potential. So I'm hedging my bets, right? So I'm buying something that's fallen by 50% from its high and selling something that's fallen post bad results, but still keeping exposure through Pilbara. And so the news, obviously, the other day was good for Min Resources, less debt and a bottoming in lithium prices, but we've still got to see follow through. But unequivocally, everybody needs to have some uranium exposure in their portfolios because I think we'll be surprised over the next 2 to 3 years how strong that is and how underinvested the markets have been for such a long time in it.
So just a quick comment on the switch thing. And again, that mentality piece is if you had $10,000 you're investing today, you had to side by side Min Resources versus say Paladin, you've got to ignore, you look at it like that. You don't look at it, okay, I paid 56 for Min Resources and it's 37 or 8 or whatever it is today, removing that is difficult for people to do because they can see their buy price. And I think that's an easy way we educate them around what would you do with that money today, not just be irrational about selling at a loss. And also reminding people that when we bought Min Resources for a lot of clients, it nearly doubled quickly and we actually sold half at that point in time. So there was a lot of profit taking done early on that one as well. So again, with that full picture of time around that, it's not just a simple buy and loss and see you later.
No, well, so Min Resource to Paladin or Next Gen any day from here, right? So it doesn't mean Min Resources is going to underperform. So if you've got no lithium exposure, if you've only got one lithium exposure, Mineral Resources, and you've got uranium exposure, maybe you sit there. But if you've got Pilbara, Min Resources, and no uranium, it's an easy switch. My issue is going forward here is like uranium stocks have fallen by 50%. To me, the demand outlook is outstanding, right? And it just got a hell of a lot better. Like literally 2 days ago, there was a tweet from Vladimir Putin saying, maybe there's no more uranium to the West. And that's so bullish, it's not funny. But we're talking the lithium market is cutting production. So we're going through this bottoming phase of when like these can drag on for 2 years. So as a portfolio manager, sometimes we get things wrong or the price doesn't go our way. And there's a like for like opportunity where, yes, it stings taking losses on a stock, but also you're buying something that's fallen significantly. And at the same time, Paladin, for example, just got the go-ahead they're absorbing another uranium mine in Canada, right? So they've just got access to a bucket load more pounds. And so should the uranium price go higher, then obviously they'll do exceptionally well. Yeah, so that's the thinking there.
Beautiful. Well, as Ben and I both know, it's good fun and we can definitely go down some rabbit holes when chatting with you, Sam. We love listening to you, and I think for clients, it's a good insight into sort of the expertise and understanding that you guys have in the market that you use to actually support our clients and our client portfolio. So, mate, thanks for the time today. Greatly appreciated. Sam, Ben, you got anything else you want to say in closing?
No, I'd just probably sit here for another couple of hours and throw some ideas around. So I think it's best you call us short.
All right.
Well,
all
hey,
good.
nice to chat, guys.
Good on you, Sam. Thanks, Ben. Cheers. We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britain FP, or Google Burke Britain Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility. Do your homework. Ask questions and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.